going to do today, folks, is we're going to use a real life experience of a stock that's gone wrong on somebody. And rather than sitting there just watching it go down, what we're going to teach you today is a repair strategy. It's really how to get out of the stock at a cheaper price than what you paid for it, at break even or close to a profit. So that's the objective of today and what we're going to do. And Adam is kindly sharing his portfolio here today to use that as an example of a share called Rocket that Adam has purchased. He owns 100 shares of them, and since he's bought them, they've gone down. And what we're going to do is just really share how Adam can actually repair this position without having to wait for the share price to go back up to the original price that he bought it at. In other words, he's going to be able to get out of this cheaper than what he paid for it and potentially at a profit. So thank you very much, Adam.
You're welcome, Stephen.
So I'm going to talk you through that, Adam. So if you could just maximize your portfolio window, and what we'll do is we just we show people. So we're going to release this in a podcast version and a video version. So for the benefit of people at the podcast, Adam here has bought 100 Rocket shares at a price of $25. And as it stands right now, they're trading at $21.55. So Adam is down $3.45 a share, or $345 on the position. So it's not the end of the world at the moment. Shares kind of go up and they go down, but in kind of short periods of time. But it's over the medium to long term is really what you buy individual companies for. So what we're going to use here, Adam, is an example of maybe you've changed your mind and you don't think it's worth $25 anymore. Maybe it's worth $23. And what I want to share with you, Adam, is how you can actually get out of Rocket at 23 and still make a profit. Does that sound good?
Yeah, sounds great.
Great. Okay, so what we're going to do, it's a very simple strategy. I call it the repair strategy, but we're going to use the call options market. So what people typically do when a share falls, in order to reduce the cost in the share, a lot of times investors go in and buy more shares. And they do a thing called dollar cost averaging, which is basically buying more at a cheaper price, which obviously builds down the average price of the entire position. Now, I've only one problem with that, and that's, let's say you no longer believe in that stock, or you think it's not worth what it is today even. Well, then really all you're doing there is doubling up on the problem, and you're not really finding a solution. So rather than doing that, what I've come up with is a strategy whereby you can actually use the call options market to put a trade on that will cost you nothing, maybe even generate a credit for you, and get you out of that share at a cheaper price. So let me talk about that a little bit more and trash it out. So if you look at Rocket there, you have 100 shares of Rocket. If you were to double up in the position, buy another 100 shares, you're adding another $2,000 bill to your account. And if Rocket continues to slide, you're in trouble, Adam. Is that fair to say?
Yep.
Okay, so what we will do instead is go and look at the options market. So I want you to open up your options chain. And I want to use an example whereby we're going to get you out of this at 23 if the shares jump back up to 23. And we're going to go out to maybe October the 16th. Okay, so what you're going to see there is the call option prices are going to jump up there now. So we could buy, for example, the $21 call option and pay out $2.35 a share. You can see that where it says last price there for your calls. So what that will entitle you to do, Adam, is to buy another 100 shares of Rocket at $21 any time between now and October the 16th. So if Rocket jumped up to $25, for example, you'd be able to come in here, buy another 100 shares at 21 and sell them at 25. And the cost of that to you is $2.35 a share. Now, the only problem with that as well is there's a cost involved, and it's $2.35. So if Rocket doesn't rise in value, you're going to lose your $2.35. So what we do to offset that cost is implement part 2 of the strategy, which is a covered call strategy. And that's where now, if you think about it, we've owned 100 shares of Rocket. we have this call option now that allows us to buy another 100 shares at 21. So in theory, we actually have control over 200 shares of Rocket, even though we only own 100 at the moment. Is that clear?
Mm-hmm.
So what we would do then, in order to reduce the cost of buying that $21 call option, is sell twice as many of the $23 calls. Let's call them covered calls. So as you can see there, we're taking in 150 per share for selling the $23 call option. But now, because we can sell twice as many, because we've control over 200 shares, we're actually taking in $3. So this trade we're putting on now, worst case scenario, is going to generate a credit for us of 65 cents a share, because we're taking in 3 for selling 2 contracts of the $23 call options, and we're paying out $2.35 for buying 1 contract of the $21 call option. So our net credit to us there is 65 cents a share. So worst case scenario here, and I'm going to show you in profit and loss tables now in a moment, we're going to reduce our break even in Rocket by 65 cents a share. That's our worst case scenario. But come October 16th, one of 2 things is going to happen. Let's say Rocket does get to $23. Well, you've taken in your 65 cents a share. The value of your $21 call option will be worth $2 a share. Okay, so that's now $2.65 in value that you have from this particular trade here. And you're going to basically get rid of your shares of Rocket at 23. So remember now, you bought them at 25, you're selling them at 23, so you're losing $2 a share on that side. But what you've done on this call option strategy that I'm telling you about here is generated $2.65 in premium. So that will actually leave you with a net profit here of 65 cents a share. So even though you're selling the shares $2 cheaper than what you paid for them, you're actually getting out of the profit on the entire position. Does that make sense to you, Adam?
Absolutely.
100%. Brilliant. So I think the best thing to do is if you could just write down those premiums there. I'm actually going to go through the profit and loss table on this, and I think that's the best way of demonstrating it to people who may be looking at this for the first time. But what I'm really trying to stress here is that an awful lot of times people get themselves into positions on stocks and they bury their head in the sand. They may have changed their mind on the company and kind of, they may think that this stock is no longer worth what I paid for it. And rather than doing something about it, they stay in it. And then it just gets worse and it gets worse and it gets worse, rather than managing their way out of the position. And that's what this strategy is all about. So what I'm going to do now is just really share with you how this all operates. So what I'm going to do on my side is actually spell out, and I'll take control of the presentation now. I'm going to spell out for you what the P&L will actually look like if we did nothing, and then I'm going to compare it to what it actually looks like if we actually do something about it. So remember, you would only ever apply this strategy if you've changed your mind on the position. You no longer believe in it, okay? So here's Adam's current position. He owns this company called Rocket. He owns 100 shares of them, and he bought them for $25. So his cost in the trade is really, it's what the 100 shares multiplied by what he paid for it. So he's into this trade for $2,500, which is, now what we're saying here is that Adam no longer believes in this particular trade. He now believes that, his new target price for Rocket is gone down to 23. So for whatever reason, Adam has changed his mind. Now, if Adam doesn't do anything on the stock, he's going to lose $2 a share or $200. So let's say Adam is correct. The shares do go to 23. He's going to lose $200 a share. Does that make sense to you, Adam, there? You're with me so far?
Absolutely.
Yeah, okay. So what we're trying to show you here is, rather than losing the $200, is there any other way of Adam getting out of this position at a profit? Okay? Now, the current share price of Rocket is, I think it's at about 21.65 in and around there.
Yeah.
So, currently Adam is down quite a lot of money. So he's down $335. So that's nothing to be sneezed at. So what we're going to show you now is by implementing this repair strategy, how the goalposts are going to change very quickly, and what we can get out of this $23 strike here, and we can get out here at break even though if we did nothing, we'd be losing $200. So let me spell out the trade in detail again. So there's two legs to it. So let's call trade one. We're going to buy the October 16th $21 call option. And the cost to us was
$2.35.
$2.35. Okay. So that basically gives us the right, folks, to control another 100 shares of Rocket at basically $21. That's what this trade here does for us. Okay. So in other words, we now have control over 200 shares of stock. So what we're going to do now is put on the second trade, which is basically selling a covered call on our total control position. So we're going to sell the October 16th $23 calls. And this time we're taking in premium, we're taking in 150 a share, I think it was.
Yeah.
Okay. Now, don't forget, folks, we're actually taking in twice as many. Because we own 200 shares, we can actually sell two of these here. So there's actually three trades going on, but all I'm going to do here is go and sell multiplied by 2 here, just to keep it easy. So we're actually taking in $3 in premium here for a net credit here of 65 cents a share. So we're actually taking that money into our account. It's $65 for every 100 shares. So no matter what happens here, we're guaranteed to keep this money. Absolutely guaranteed. So there's no fallback here whatsoever. So just to explain what both trades mean now. So we have this original stock position, we own 100 shares, that's fine. We also own this call option that allows us to buy another 100 shares at $21. And then we basically obligated ourselves to sell those 200 shares if we do go and buy them for $23, okay? And the net income to us out of doing that is 65 cents a share. So the best way of seeing what your P&L would be is actually doing what we call a profit and loss table. So I'm going to start here at $18 and I'm going to work my way all the way up, let's say to $26. Okay, so what we're saying here with this particular line, guys, is that, you know, what if on October the 16th the share price of Rocket was $18? What would it mean for in terms of P&L for us? What would it mean if it was at 19, at 20, and so on and so forth? So the first thing we put in is the information we already know. We already know what we're in this particular trade for. So we already know that we have 100 shares of Rocket, and we know that we paid out $25 a share for it. So we put in that known information. So the reason I have minus 25, guys, that's a cost to us, that's what we paid for it. But we also know that we put on this option, call option trade, and we generated a credit. So we'll put in here the premium received for our repair. Okay? So we know what we got in here. And we took in 65 cents a share. So that's a benefit to us. It's not a cost because we took it in, it's a credit, and that's fine. So now what we've got to do is really fast forward the clock. We've got to say to ourselves, right, okay, we own these calls. So what is the value of these calls on October the 16th? So we go value of $21 call. And that's an asset to us. So if there is value in it, we're going to benefit from that. So we know that we own this $21 call option. That gives us the right to buy 100 shares of Rocket at $21 at any stage between now and October the 16th. Now, if the shares were trading at 18, we wouldn't exercise our right to do this because we can buy them at 18. Why would we buy something at 21 when we can buy it at 18? So there's no value anymore in that particular call option. And there's no value right up to $21. But after that, at 22, there's $1 of value. So again, just to explain, if you think about it, if I've got the right to buy 100 shares of Rocket at 21, but in the open market they're trading at 22, then there has to be $1 of premium in that, because I can buy something for 21 and sell it immediately at 22. If the share price is at $23, the value of that call is $2 per share, and so on and so forth. So that keeps going up in line with the each dollar increment here. Now don't forget here, we've got two sets of these short calls as well. So we don't own these guys, these are the ones that we sold. So if there is value in them, we've got to express it as a negative value. And again, there's no value in that call option until we get over the $23 mark. But after that, the value is 1. But it's not a positive for us, it's a minus. And the reason is we don't own that particular call option. It's not our value, it's somebody else's. That's because we sold it. It's a covered call. And remember, we sold 2 lots of them because A, we have our rocket shares here, and B, we own this particular call option to 21. So we control over 200 shares. So quite simply now, all we do is put in our P&L for the entire trade on a per share basis. And that's just a simple case of adding up all these columns. And I'm going to talk you through each one of those now. So you can see here that if the share price drops to 18, we're still going to lose $6.35 a share. But that's even still better. If you think about it, if we did nothing with Rocket at the moment, so if Adam does nothing, and he just owns this particular stock at $25 and the shares drop to $18, that means he's minus $7 a share multiplied by 100, so he's down $700. But by us implementing this call option repair strategy, you can see he's only down $6.35 a share. So worst case scenario, Adam has reduced his risk by actually putting this trade on. I hope that makes sense. Does that make sense to you, Adam?
Yeah, absolutely.
Okay, so let's get up to where our target price is. You can see here at our target price, Adam has now gone from losing $2 a share if he did nothing to making a profit of 65 cents a share, or $65 for every 100 shares. It's the same at 24, the same at 25, and here's the thing, that it's the same at 26. So the max now, Adam, you can make out of this trade is 65. So let's say you put this trade on and the share price jumps up to 30. Well, you're not going to benefit from that rise to 30. The maximum you're going to benefit from is its rise to 23. That's it. But what I'd say to you is don't forget what your outlook for the trade was. You'd now change your mind. You were getting out anyway at 23. So it's unlikely you would have participated all the way up to 30 anyway.
Yeah, I would have sold out.
You would have, exactly. So this is how you repair losing stock positions. So for me, guys, this is like the holy grail. This is why I love option trading so much. This is a situation that's gone wrong for a customer. We're showing them how to get out of the trade for a profit at prices which was much lower than what he actually paid for the stock. And it just goes to show you what you can achieve with a bit of knowledge. So any questions on that at all, Adam?
No, not at all. It's fantastic strategy.
Yeah, absolutely. So that's what I would do with your account, Adam. Just if you want to take back control again, just very simply, I would actually go and buy your October 16 $21 calls, sell twice as many of the $23 calls, and if Rocket rises back to 23, you'll be out of that position at a profit.
Fantastic. What I'll do once I line the trade up then, and once market opens, I'll exercise it.
Absolutely. And that's a case of a share down about 10% from where you bought it, guys.
Yeah.
But you can manage shares down as much as 20, 30% with the same strategy. You just have to pick different time horizons and different expiries. So that's the benefit, I suppose, of what we're doing here with our customers. We're showing our customers not only how to pick quality stocks, but even quality stocks don't go your way at times. Things go wrong. Maybe they've had a bad year. And then you've got to figure out how to manage your way out of it. And that's really the benefit of what we're providing for people like Adam here.